For clicking in on this video. Today we're diving into the state of Canada's sluggish housing market, which seems to be in recovery mode after recent interest rate cuts from the Bank of Canada. This insight comes from a fresh report by Royal LePage, one of the most respected names in Canadian real estate. However, this isn't the first time Royal LePage has made bold predictions. You might remember that just last December, they forecasted the home prices would return to their pandemic peaks by 2024. That prediction was not without much scrutiny. In this video, we'll take a close look at what the new report says, why early predictions missed the mark, and the potential impacts of the government's upcoming mortgage rule changes. These factors will shape Canada's housing market in the next few years. But before we dive into the details, make sure to hit the like button and subscribe to stay updated on all the latest developments in the Canadian real estate market. Now let's get into an analysis. The Royal LePage report addresses the current state of the housing market, pointing out that despite 3 interest rate cuts from the Bank of Canada, many buyers remain hesitant. This reluctance has surprised the industry, particularly since earlier surveys suggested that the significant number of potential buyers were waiting for cut rates to jump back into the market. According to Royal LePage poll, half of the potential buyers who had paused their home search said they were ready to buy once rates were cut by 25 to 100 basis points. Despite these cuts, however, the buyers are still holding back. Royal LePage attributes this hesitation to first-time homebuyers adopting a wait-and-see attitude, with prices staying flat and interest rates declining. Buyers don't feel rushed to make a purchase. In simple terms, they don't see any penalty for waiting, so they choose to delay their decision. The real reason why the buyers are waiting is because there is no properties out there in their price range. Either the houses are too high in price and they don't qualify, or the houses are so low that they're really disgusting houses. They don't want to buy it and have to put money into it. This buyer's hesitation is important to note because it contradicts the early belief that lack of supply of the broader economic fundamentals would drive demand and push prices higher. Instead, it seems buyers are operating on assumptions that they won't lose anything by waiting. This brings us to a well-known phenomenon, FOMO, or fear of missing out. Buyers don't want to miss out on a good deal, but they're also cautious about making a move before they're sure the market is right for them. And since there are no houses for sale in their price range, the market's not right for them. It's time they built more homes in that price range. Now here's where it gets interesting. The report predicts that as confidence in the market grows, buyers start to anticipate rising prices again. We'll see increased activity. In other words, Royal LePage expects a surge in demand once buyers fear that prices are about to rise. This forecast suggests that the market is not necessarily being driven by those strong economic fundamentals, but rather by the buyer's psychology and the fear of missing out. I know they're talking a lot about the fears of missing out, but if there's no houses in their price range, it only makes sense buyers are not buying because they can't find a house in their price range. It's a bit unsettling to realize that the housing market might be driven more by perception than reality. Think about it. Buyers will jump into not just because they believe the economy is strong or because housing is affordable. It's because they found the house that fits their needs and fits their budget. That's why they jump purchasing a property. But because they're worried prices will go up, it's a delicate situation and one that makes it difficult to predict the future of the market with any precision. Noticing all these little side steps Royal LePage is taking, but the reality is, if they only are pre-approved for, let's say, $500,000 and there is no house in that price range, no matter where they look, they're not going to buy a house. The prices of houses have to come down, or there's got to be more on the market in their price range. Mortgage rule changes, the 30-year amortization period, one of the major factors influencing the market moving forward, as is the government's introduction of a new mortgage rules extension of a 30-year amortized period. The idea behind this move is to make home ownership more accessible by lowering monthly payments. But there's a potential downside. Increasing borrowers' purchasing power could push home prices even higher. Critics argue that while this move benefits the real estate industry, it doesn't necessarily help affordability for the average homebuyer. Essentially, giving people more buying power without increasing supply could simply lead to inflated prices. This could end up making it even harder for first-time buyers to enter the market, despite the government's intention to help. During a recent interview on Bloomberg, Royal LePage CEO Jeff Soper was asked about these new mortgage rules and their potential impact. Soper acknowledged that these rules were likely introduced for political reasons. He also noted that while they might push prices higher, the timing of the implementation during the relatively slow market could help mitigate some of those effects. Soper suggested that these rules being introduced during the market highs of 2021 or 2022, they could have caused an even greater spike in home prices. The mortgage renewal wave, is it really over? Another key topic discussed in the report is the much talked about mortgage renewal wave. Many homeowners who locked in ultra low interest rates during the pandemic are now facing higher renewal rates, which could bring more supply to the market as some people struggle to afford their new payments. However, Soper downplayed the significance of this, claiming that the renewal wave is already halfway over and that by the end of 2024, most of the pandemic-era mortgages will have been renewed at the higher rates. Seeing that he's not really paying attention, there's more and more mortgages that are going into foreclosure. Their bankruptcy rates are going higher and higher. We're not going to be out of bankruptcy till end of 2025. You could probably buy a house, but when the bank is going to lose so much money on it, they're not going to really give you a deal on it. They never do. They have to make their money. This is where the numbers start to get a bit murky. According to data from Statistics Canada, about 35% of all mortgages were set to renew in 2026. Prominent economists such as Dave Rosenberg have pointed out that the mortgage renewal wave is backloaded, meaning that the majority of renewals will occur in 2024, 2025, and 2026. This makes it unclear where Soper is getting his data, but that 75% of the pandemic mortgages have renewed by the end of 2024 seems questionable. Another sidestep, I don't think he knows what he's doing. Let's break down the numbers. Based on Statistics Canada data, 1.5 trillion worth of mortgages were advanced between 2020 and 2021. Of these, 389 billion were 5-year fixed-rate mortgages, meaning about 30% of those mortgages are set to renew in 2025 and 2026. This suggests that a significant portion of the pandemic-era mortgages are yet to renew, contrary to Soper's claims. Additionally, 34% of mortgages taken out during 2020 and 2021 were variable rate mortgages with fixed payments. This means that many homeowners with variable rate mortgages have yet felt the impact of rising interest rates. The full effect of the mortgage renewals wave may still be ahead of us, and it's difficult to predict how this affects the housing market over the next few years. They're saying that everything is going to come to an end at 2024, only to see if they can convince people to buy houses and sell houses. Looking further ahead, Royal LePage predicts that home prices will start to rise again in 2025, with increased activity expected in most markets outside of Vancouver and Toronto. While this optimistic is certainly welcome, it's important to approach these predictions with caution. The market's current state is heavily influenced by the buyer's psychology, and it's difficult to predict when or if the coincidence will return in a meaningful way. The potential for a market rebound in 2025 depends on the various factors, including economic conditions, inflation rates, and how the housing supply evolves in the coming years. If buyers continue to hold off the anticipation of further rate cuts or price declines, the market could remain sluggish for some time. Conclusion, what should you do? So what does this all mean for you, especially if you're considering buying a home? First and foremost, don't let fear of missing out drive your decision. Remember that. While Royal LePage and other industries insiders predict a recovery in the coming years, it's essential to make the decisions based on your own financial situation and long-term goals. The best advice I offer is that you trust your own budget. If you find a home that you love and it's within your budget, it might be the right time to buy. Don't feel pressured to jump into the market based on predictions that may or may not come true. The housing market is unpredictable, and even the experts can't always be right. So take the time to do your own research, weigh your options, and carefully and make sure that whatever decision you make is the right one for you and your family, and not what your neighbor's doing. Because if your neighbor is getting deeper and deeper in debt, don't follow that strategy just because you want to keep up with your neighbors. We'll continue to monitor Canada's real estate market closely and provide you with updates as new data becomes available. If you found this analysis helpful, don't forget to like this video and subscribe to the channel for more insights. Thanks for watching, and see you in the next video.